Happenings with Holly. I'm Holly Waxman, and I'm thrilled to be here with some of my favorite people, Adam Dahlberg, Sarah Perkins, and Ryan Nelson will be here soon. I'm excited about the show because we're going to give you some real, actual updates on the Phoenix market and avoid any of the rumors that are out there in the public.
There's a lot of them in there.
There are.
Yeah.
It's crushing consumer sentiment.
And you know all about rumors. You're the data queen. So let's crush some of them.
Well, and that's probably the biggest thing that's out there right now is there's so much clickbait and people don't know what's real and what's not. And so by providing what's actually happening can create some stability and confidence. And that's what we need in this marketplace.
Yeah, I have clients, every time they pick up a newspaper, they lose 5 minutes more sleep a night. It's unbelievable what's going on out there. It's just really kind of scary, So
It's so sad.
But weekend is quickly approaching, and this is my favorite time of year. This is our 2 weeks out of the year where it's either not extremely hot or miserably cold, which, I'm from Arizona, so anything below 70 kind of really pisses me off, to be honest with you. But I'm enjoying it. Going up to Las Vegas tomorrow. We leave in the morning. My son, as you know, plays hockey, and so he's got a big tournament up there. We're going to be ingrained in multiple ice rinks up there, so I guess I'll just be cold all weekend. You'll be down here enjoying the nice warm weather.
Yeah.
Or cool weather. What is this, warm or cool?
Perfect weather?
Perfect weather, yeah. Margarita weather.
That's right.
I'll be drinking a margarita out of like a 3-foot long, those things they have like a lanyard. You gotta walk around. You just look like a total degenerate.
You just have a parka on while you're doing it by the ice rink.
So here's the best part about him playing hockey, right? So, he did all the young kid sports. He did soccer. He tried the baseball. Hockey is kind of like baseball. If you've ever known like a baseball family, right? It's just as intense. Sometimes they have like 2-3 games a day. They'll have a tournament all weekend. Outside, hot, melting. You got to drag your lawn chair to the field. You're sitting out there. Maybe there's a refreshment stand over here selling lemonade or whatever. Hockey, you're indoors, right? It's hot outside. It's nice and cool in there. And they all have a little bar. They all have a nice little restaurant. You could sit there on the window and watch your kid play, have a couple of cold ones, throw a jacket on, a little, like a little hoodie, maybe a beanie or something. No dragging chairs, no having to walk 3 miles to go find a bathroom. It's the best sport out there, which is why it's probably so expensive.
That's kind of awesome.
Yeah.
I was going to say my kid who's a gymnast, we can still be inside, but
you're like in a high school gymnasium, right?
Yeah. And they're like 4 or 5 hours long.
Yeah. So my son did Taekwondo growing up. He's almost a black belt, right? He had to go through all the young kid phase, which he had to go white through black, but like kid white through black,
That's
right?
What my son's doing.
There's a black stripe, right? A yellow stripe.
Yep.
And then he finally started getting into the colored belts, and he is a brown belt now, which I think there might be a red and then a black.
Father here, right?
Right, but anyway, so he's almost.
That's pretty awesome. I like it.
But he's got to sit in that phase. Same thing. I can't tell you how many junior high bleachers I sat on. You have to be there to register by 7:55 because at 8:00, registration's cut off, and it's in Sunny Slope or it's in.
Yes.
Right. It's never closed.
I've been to 2 at Sunny Slope already.
Horrendous. And then we look at the thing. It's like, well, his division doesn't even start until 2. I'm like, what? It's so far away, and it's just the high school bleachers. The gymnasium bleachers.
Oh, yeah.
You get, but anyway, so Vegas, right?
Right on.
I will put some money down on a number for you.
And you'll be at 28 because that's my birthday.
28. Okay. And your birthday's this Friday.
This Friday.
Well, what are you doing on Friday? You coming up?
I'm going to be with my daughter and some girlfriends, and we're going to have a day of beauty.
I love that.
Are you going
Good
to the
for
spa?
you.
We're going to Beauty Propaganda. I'm a member there now.
Beauty Propaganda. Okay. Is that where you got your hair? I just saw you did your hair.
Yeah, I got my hair done there. And
Right on.
Yeah.
Beautiful.
Very fun. And then we're going to go to lunch. That'll be a nice lunch. And I'm looking forward to it. Another year. Wow.
Sounds so excited.
Yes. This is it's always like weird, your birthday.
Is it a pivotal birthday? You don't have to tell me the number, but is it a pivotal birthday?
They're always, right?
Are they?
I think
Is it a
so.
milestone birthday?
No.
No.
Just another birthday.
Just
But
another
anyways,
birthday.
and my daughter, she teaches yoga.
Okay.
And when she was a little girl, she always put a star next to her name, Brittany. And now when she goes out and does her yoga classes at Core Power, I see my star.
Yes.
Okay.
She continues with it.
Yeah.
The star keeps going.
So you did yoga?
Going. Do I do yoga? I go to her classes.
Did you teach yoga?
I never taught yoga.
Just a yoga, you just go there for the stretch.
for the stretch, the fun.
It's a hot yoga.
That's
You
right.
come out sweating.
Yes.
You just do it outside.
No, we do it in the studio.
Brutal. I used to work at a real estate office
bring
in
myself to do that.
Gilbert years ago, and right next door was a hot yoga studio, and then they expanded, and they took over the side that was right against our building. So there was a space initially, and then they expanded, and it was so gross because I had an office, and my window right there was towards the front, and people would come out of this thing literally dripping, like wringing their shirts out, like just looked like they, just walked across the Sahara, and like the whole front was where they would all park. So it was hard to even find parking because every hour they had these classes and they were packed. And I just never saw the appeal in that. I mean, clearly a lot of people did, but they would come out of there, no shoes on, they're dripping sweat, leaving sweat stains all up and down the sidewalk in front of our building. It was pretty nasty.
It's a body form. It's a body form.
Oh,
It's
a
a balance.
It smelled in there. God, can you imagine?
Oh, I've heard it's bad.
Yeah, I mean, it'd be so nasty. But to each their own. I do yoga on Sundays though at my gym, but it's not that crazy hot yoga. It just kind of stretches you out a little bit because as we get older, things start cracking and popping a little bit. So I need to stretch those out. So I'll try your daughter's. Where's she teach at?
Core Power,
Where's that?
right here in South Scottsdale.
Oh, okay.
Yeah.
Close.
Not far.
All right.
Right
Yeah.
on.
Yeah.
Well, Sarah, you down?
Fine. Fine. I will. I've had a slight curiosity, mostly like how horrible is it because it seems horrible. So there's that curiosity of maybe that's a thing I'll try. So
Well, it does a
if
body
you
good.
do it, I will.
All right.
All right. We'll have a party there.
Yeah. Sounds good. Sounds good.
So,
So how about your weekend? What do you got going on?
I've got a gymnastics competition with one kid. I've got a dance convention with a different one. And then my son is he's got a red stripe and a taekwondo belt. And he's got a little thing in the morning too. So I'm running around with children.
Awesome.
Cool. Well, now we get to welcome our favorite lender, loan officer, Ryan Nelson.
Hi, Ryan.
Welcome.
How's it going?
What's up, buddy?
Excited to be here.
Yeah.
We're just talking about the weekend. What are you doing this weekend? But you might need to hop on and hear us.
Don't mess up the hair.
You look good, Ryan.
Thanks.
Glad you can be here.
Good to see you. So, well, busy for you, obviously.
Yeah.
Yeah.
Running around with kids, divide and conquer.
But how old is your oldest?
11.
Okay, so they're relatively young.
11,
relatively
9, and 7.
Still needy, not self-sufficient yet. Maybe the 11-year-old. You leave alone for a while.
Yeah, yes, but only her.
She can make her own food yet, or yourself?
Yes. No, she can handle it. The others two, they
Ryan, what are you doing this weekend? Anything fun?
No plans this weekend so far, so we'll see how it goes.
That sounds amazing.
Go with the flow. So anyways, Ryan, well, I'm glad you're here. And why don't you introduce yourself?
Ryan Nelson with AmeriFirst Financial.
Okay. Cool. So, and then we have Adam Dahlberg, my favorite listing partner at 72 Sold.
Thank you. And same to you.
Thank you. And I'm so lucky to have a listing partner like Adam because Adam and I, since I met him, it was just a wonderful chemistry. And we have been really lucky that every listing we get, and I think we're one of the top listing agents, we're selling them.
It's weird how things click like that, right?
Right.
Yeah. And you touch on a good point. I mean, well, utilizing our program, a lot of people can go out and secure sales, to get the listing, but to actually get them sold and closed that's a challenge these days, isn't it?
It's a big deal.
We got it figured out, I think, a lot better than most.
And what's wonderful about the program at 72 Sold, today we're on a call, but it's true. We're getting 8 to 12% higher than traditional agents with the program. And
it's crazy how it works out when you just follow the plan that's in front of you.
That's right.
What a great company to be part of. Were you on the national call today? Did you
I
hear
was.
what was going on? It is blowing up around the country, isn't it? I mean, just the amount of activity and the amount of agents signing up, and they're really going to launch into something huge. I mean, on a national level. I think we're already, before this, we were in 38 markets around the country. I'm imagining we're in all 50 states at this point. 72 will be in all 50 states. Canada too?
I believe there might be some up there. I know there's some in other countries, and there's, Guam. There's everywhere. Yeah. And it's grown really quickly, and it's been very successful across the country.
Yeah. What I found remarkable is Gary Keller even saying how he believes in the program and he thinks that's the system that's going to work. And
I'll tell you, there's probably before Greg, there was no other high level real estate trainer in the country, that was doing more than Gary. You had all the Tom Ferries, right? And what was Tom's dad's name?
Mike Ferry.
Mike Ferry.
Tom Hopkins, right? He was a big guy out there. Brian Buffini was a big guy out there.
Buffini still has a big following out there.
Yeah. He was one of the first real estate trainers I ever went through, like as far as a training program.
Me too.
At the time, it was like, man, if you want to be a really good real estate professional, like that's the way to do it. And all those keywords, right? The pop buy. It took me weeks before I realized he was talking about a pop buy, not the character, not the guy.
Oh,
like,
Adam.
A pop buy. What the hell is he talking about? Like, is he into spinach or something? What is this guy?
Popeye gifts.
Popeye gifts. I'm like, yeah, am I supposed to bring him a can of peanut butter and spinach, or But so all these big trainers, and then just Greg out of the woodwork came out with this 72 program, and is just changing the world really with it. At least what we were doing here in Arizona, now on the national level, to the point where guys like Tom and Gary are not only taking notice but teaming up with and going and almost like bowing down, like you're the GOAT, right?
Right.
And we got in really early. It's so cool.
Yeah, it was really great. And it definitely, from being an agent for 20 years and now being here with 72 Sold, I can say firsthand, it really does work. And we are helping so many sellers as well as buyers get, amazing profits.
And that's a really big deal when it comes to a lot of the different programs that are out there. We know that there are different models, and, we know about the power buyers and the iBuyers and the different products. But one of the things that we know about a lot of the different systems out there is the consumers, the sellers don't necessarily make as much money, or they don't get to bring home as much, and when people talk about it and think of when they're thinking of 72 Sold, they're like, oh, is there a buyer or is this? And it's no, this is regular homeowners, regular sellers who want to maximize, their profits so they can go and buy the next home and move on and do what they need to do. And they get to keep that. And so this is a program that not only is successful within the industry, but it is super successful. And I know you talked about it already, Holly, but super successful for the consumer, because there's been headlines saying, well, we know that this is the most expensive, over here is a very expensive way for sellers to sell their home, or here's a way with 72 Sold that they can sell their home for the most money possible. And that is, to be a giant program and be so beneficial for the consumer, is why it's been so successful. You know what I mean? Does that make sense?
Mm-hmm.
Right.
Yeah.
Like, it's a really big deal.
Yeah. Well, we're coming up on our break, so why don't we dive into that a little bit further when we come back in a minute? Cool.
The reason behind, where things are at.
And I can add in housing economist stuff, kind of feedback on what he says to piggyback.
All right.
Cool.
So here we are back with Housing Happenings with Holly. And once again, we have Ryan Nelson with America First, Adam Dahlberg with 72 Sold, and Sarah Perkins, our Clear Title and our economist. So Ryan, why don't you start with telling us about a little bit what your pulse on the market?
Well, the pulse of the market is affordability is really tough right now. Home prices obviously soared during COVID due to shortage of supply, and we're starting to see a pullback in prices, which is good. And it's making things a little more affordable. But on the flip side of things, we've seen interest rates get higher and higher. We started the year off in the mid 3s. During the summer months, we were in the mid 5s, and right now we're around 7%. So that doesn't help someone wanting to purchase in regards to what their monthly payment's going to be. So there are some things that are available to help people with that. But let's talk about why rates have gone up. The main reason is inflation. And inflation is simply too many dollars chasing too few goods. There's a lot of money out in the economy, and it has pushed prices up. And so the Federal Reserve to try to combat inflation and try to bring prices down is basically increasing rates, and they've done it 4 times this year to try to slow down, the cost of goods rising through making it more expensive to borrow money. And, they use their monetary policy as a tool to do that. So it's gotten more expensive for everyone. So they're trying to take dollars out of the economy to be able to bring prices down. And so we haven't seen clear evidence that we've started to turn a corner yet. We have seen inflation, or the rate of inflation increasing, start to slow down. But it's still, until we start seeing the actual stuff coming down, rates are going to stay at these elevated levels. So people are wondering, is it a good time to buy a home? Is it a good time to sell a home? Well, in regards to buying a home, it is tough, but I do think we're in a temporary situation. Once we start seeing clear economic data, consumer price index, employment numbers be more favorable to what the Federal Reserve's mission is to bring inflation down, rates are going to come back down. So we've spiked very hard and fast. In the last 20 years, we haven't seen this much movement, especially upwards. We saw a lot of movement downwards during COVID. The Fed using some of their tools to, keep our economy from collapsing. And it's a temporary thing. Rates will come down. It's a matter of if, a matter of when, not if. Right. And it's a timing thing. But with prices coming down, the good thing for someone looking to purchase is you're going to be able to get a lot better deal on the home.
Yes.
You can't change the price you buy for a home. And you go back a year ago, people were overpaying for homes. Due to lack of supply, people were paying more than the property was worth. That was pretty common. And now we're seeing sellers drop prices because there's not as many buyers. It's simple supply and demand. And prices are starting to come down, which is good for buyers. And, one thing that people are saying out in the marketplace is you date the rate, you marry the home, and divorce the rent. and it doesn't matter if you own a home or not. You're paying rent, or you're paying a mortgage. You're either paying your own mortgage or you're paying someone else's. So,
true.
The good thing is there's some things with home prices coming down. Sellers are a lot more negotiable now. Not only on giving a better price, but also we've seen the seller concessions come back into the market in a big way.
Yes.
And one of the things that's becoming increasingly popular is doing a temporary buy down on the interest rate. So, what that is you negotiate with the seller to pay your interest rate difference. And, for example, if the current rate's 7%, you can offer a homeowner to get into a home for 5% interest rate, and that would stay at 5% for 1 year. And then the next year it'd be 6%, and then they'd be at 7% on that third year. So, it's becoming common for that to happen. And on a $400,000 loan, I was just looking at this for a client today, you're talking about a $500 a month savings from a 7% interest rate to a 5% interest rate.
Wow, that's great.
So basically, the first year, it's a $6,000 savings. You have $500 a month times 12 is $6,000. And then the next year, it's a $250 savings. So it's $3,000 the second year. So now you're asking the seller when you negotiate to purchase that home, hey, if you'll give me $9,000, I'm able to get into this home and be able to save $500 a month for the first year and $250 for the second year. And every financial economist out in the marketplace is predicting rates to come back down. It's just a matter of, is it going to be 6 months? Is it going to be 12, 18, or 24? But they're going to be back down, hopefully, back to where we've been historically, around the 5% range. And if they are, you're able to take advantage of that today, even with interest rates being at 7%, by doing a temporary buy down.
I think that makes a gigantic difference, because we even saw when rates hit 5% in August, when we had a little dip, we had a 25% increase in contracts just in a couple of weeks, because the buyers are there. They want to be here. This is a desirable place to be. And Absolutely. So we know that they're there. It's just about what Ryan was saying, affordability and the interest rates and prices.
Well, and for this particular client, he can afford the home. He can afford a payment of $3,000, but he doesn't want to pay $3,000. His current rent payment's in the low $2,000 range, but he really likes the home. So this is a perfect solution for him if he believes rates will come down. He's willing to pay for that now. He's getting a phenomenal price on the house that's getting accepted. The literally $75,000, less than it would have been. And so for, the seller's willing to give some money, they want to sell the home. And this is allowing him to feel comfortable to be able to consummate the transaction and get into the home that he wants and have a payment that's affordable, for the next couple of years. And hopefully everything goes as planned. Hopefully inflation comes down, rates start to come down. And now he's going to be able to get and refinance that loan into a lower interest rate later on in time once rates come down. So it's a good solution, and it's you just have to put together those solutions for people. But so much more important to get a great price on the home than worry too much about where rates are at, because I do think we're in a temporary high point, but I think we're going to be turning the corner fairly soon and starting to see stuff come down. It'll be a slow, gradual decrease depending upon what happens with the economy, but I would bet a lot of money that 12 months from now rates are at least 1% lower than they are today.
So on that, if a buyer is looking to get credit for a buy down, and in that example, they're at 7 or the market's at 7, and they get contribution to bring it down to a 5. The next year it goes up a little bit, right? And then in the second year, does it go back to 7, or does it go back to the current market rate?
It stays at the rate of 7 if that's where the rates are today, and that's where the loan is closed at. It's a temporary buy down. So the first year is 2% less. The second year is 1% less. And then on that third year, you have your normal loan, but you have the availability to refinance that loan at any point in time.
So a miracle happens and all of a sudden interest rates go back down to 4%. Within a year to 2 years, they can just refi and get the 4%.
They can refinance it, and that money that they've got set aside to pay that interest rate difference could be applied to their current mortgage as a principal reduction.
Oh, beautiful.
So
Nice.
There's $9,000 to start with, and $500 is being used every month for the first 12 months. If rates in 6 months crash down to 5%, they could refinance, and they've only used a portion of that $9,000, and now they have that amount to be taken off their balance, what's left. So it's a total win-win solution for a lot of people. And in this client, it really was what he needed to hear to make him feel comfortable with moving forward. He loves the price of the house. He doesn't like the payment, but he does believe, and he's done his research, that rates will be coming back down, and he feels comfortable to go in and write an offer and get into that house for his family. He's tired of renting. He's been renting for the last few years.
So would you say it's kind of a calculated dice roll if you were to negotiate, or your agent was able to negotiate, some kind of contribution from the seller to apply that reduction either to a rate buy down or to the reduction of the purchase price of the house, if you believe that rates are just at a short-lived high right now, that we could get back down into the 6s or 7s. I think you mentioned last week it made more sense for a client to actually apply that towards the purchase price versus doing the 2-1 buy down, because it's only temporary and he can refi because he could afford it.
It really depends upon how much you have and the person in your actual client's specific financial situation on what the right solution is going to be. And again, at the end of the day, you give them their options and let them decide what's going to be best for them.
Yeah. Cool.
Another quick story I wanted to share is, like, this week, Ryan and I we're working on a client together from one of my Zillow leads, and I must applaud, besides having such smart and professional and dedicated team here. I mean, we went above and beyond with, like, going to the bank with her, and just really, she was a single mom and she was being kicked out of her home. And whether you're, at all different prices, we're there to give you customer service and care and really make the client come first.
Yeah, really. I mean, I'll touch a little more on the situation. I mean, the lady's from Africa, doesn't speak great English, and not really familiar with how the banking system works, didn't like to keep her money in the bank, had some real challenges to be able to get her closed and be able to have everything documented correctly the right way to meet lending guidelines. But we got through it, took a little time and effort, had to make a few trips to the bank with her, and but you do what it takes to get people in their home, and it's going to be a real success story to see her become a homeowner. I'm super excited for her.
That's awesome.
Great. Yeah, I really appreciate everything you did, Ryan, and
you're welcome. She's
going to be happy, and that's another thing with working with us. I mean, we're here all the time, and we treat everybody with such care and professionalism, and not only are we smart, knowing what the best trends are, but doing what we feel is best, what people need.
Taking care of people.
There's no substitution for empathy, and the ingrained desire that you care, right? What we do, it's the same as, having that internal drive to maybe wanting to be a teacher or wanting to be a nurse. It's something that you can't teach. It's something you can't learn. You can teach real estate. You can teach how to, the ins and outs of the lending world, but you can't teach how to have empathy and care for somebody. And this is a great business for people that have just whatever that is that's built into you, that you want to take care of your client the best way possible, and you look out for them. So kudos to you. I know you have that in you. We all do. And so I think that's why it's important, if you are going to work with somebody, to either help you purchase a home or sell a home, that it's not just about the accolades that they acquire, over the 10, 15, 20 years, how many buyers and sellers they've had, but do they care? Because they will go that extra mile. They'll help you go to the bank. They'll walk you through the process. And so that's why they found a good agent in you.
Right. And it's another reason why I like working with Adam and Ryan and Sarah. We do that for our clients. Well, welcome back to Housing Happenings with Holly. And here we are with Ryan, Sarah, and Adam. And we're going to bring up the point about that we are in a recession or going into a recession, and kind of talk about how to protect everybody and how to be smart with it.
Well, if we want to kind of, one of the things kind of feeding off of what Ryan was just talking about in the previous segment was about, rates, they never stay the same. They're going to move. They always move, and they can come down and they can go up. And we do have kind of a trend of the last 45 years. Every time there has been a recession, rates have declined. Mortgage rates have declined. I know there's a lot of different talk out there about what people think is going to happen. Some, we're all guessing. Some are just better educated guesses, but we don't know exactly what's going to happen, but we just know what the trends are all telling us. And we have, I think it's been since my data goes back to 1972 that has been the case. And so as we see, and recessions are just part of the cycle of our economy. We have times when things go crazy and we have a lot of demand, but it drives up prices because of, the relationship with supply and demand. And then when things get too hot, as the Fed has decided things are too hot, which inflation has been very high in Phoenix and it's been high across the country. But, to get that under control, it may push us into a time where we do see some job loss out there in the marketplace. We do see some declines in demand, and it's just going to help us eventually equalize and balance. Some economists and some, people are looking at unemployment because we've had such a shortage of employees for so long. A lot of people are, again, it's an educated guess, but thinking maybe there won't be as many layoffs as you see in a typical recession because so many places are still so understaffed. They're just no longer hiring for the positions that they were looking for, or they're saying, no, I'm going to hold on to these employees. And so by seeing what happens with the jobs, because that will tell us how impactful, just how significant of a recession there will be, because we've seen some little blips and we've seen some bigger ones like we had in 2008. No one's expecting something like that by any means because of, all the housing fundamentals that I won't go into right now. But if anybody wants those details, we have them. But even just looking at where we're going, we have so much strong, solid potential. And even if we think, okay, we're not going to have as many job losses, that's going to only benefit our market. And we do have a lot of jobs coming to Greater Phoenix.
Do you remember what and either one of you would have this probably at the top of your head, what the interest rates looked like back in 2008 when everything kind of hit immediately? Do you know where standard interest rates were?
I know in 2006, it was like 6 and 7. It wasn't it 6, 7?
Yeah, we were in the 6% range. Rates got down into the, 4s and 5s for a short period of time. There was a mini refi boom when I first got into business back in 2003 and 4 and 5, and then rates went up. And then the rates got significantly better after the housing crash, to stimulate the economy, and just like with COVID. So when you have these catastrophic things that happen in the economy, the Federal Reserve comes in, lowers, their Fed funds rate, makes it cheaper for businesses to borrow money, lowered it to zero a couple of times, and, to try to keep things from crashing. And they succeeded. They got us through the housing, crisis. That was a massive mess. And COVID was just something that was completely unexpected and, just really kind of an anomaly, if you will. I don't think we'll ever see anything like, what happened in the real estate industry due to COVID. We saw, people buying homes, dramatically. Everyone's lives changed. Companies adapted. It still amazes me how quick companies adapted to be able to allow people to work from home. So people wanted to upgrade their homes. Interest rates got to an unheard of, 2% and 3%. That's
crazy.
Never happened before.
And it probably won't happen again.
It probably won't. It probably won't. But, if we just want to get back to some historical normal, get back into the 4s and 5s where, we're in a healthy market and it's a balanced market for everyone. Right now, we're definitely in a buyer's market and it's tough. It's tough for buyers because affordability is hard. Prices have not come down that much. And, everyone thinks, oh, geez, prices are coming down. Well, they probably shouldn't have gone up as much as they did.
I mean, we saw an increase of 62% in 2.5 years. That's not healthy and not sustainable and not really, it was too hard on the buyers.
So what happened to all these cash buyers? So, I mean, it seemed like, for that 1.5, 2 year push, all these big hedge funds, all these big cash buyers were coming in and they were just gobbling up properties, not the fix and flip guys, not the, the iBuyers, but the big hedge funds, the New York backed ones, a couple of them based out of, I think, Salt Lake were a couple. So they were purchasing properties and they were buying them at like elevated rates. I mean, they kind of led the trend, I think, before anybody else did. They were coming in and offering full market value, even with things being, but then they dropped off, right? Now they're gone. Nobody's buying. Wouldn't this be the perfect environment for them to come in and start gobbling stuff up cash?
Well, money was cheap then.
Yeah.
So they're buying with other people's money and money's cheap then. Now, if you're dealing with that, money costs a whole lot more.
Yeah.
And people aren't as excited about it. And you look at what's happening to Wall Street.
Yeah.
Well, once prices come down, you'll see people entering the market to, acquire properties as long-term rentals. Invitation Homes, I think, is the largest homeowner in the United States. It's 70-something thousand homes across the country. A big REIT that was recently created, a publicly traded company now. I think they've stopped buying recently. But, once we see rates to start to come down, like Sarah was saying, that cost of capital become more attractive, you'll see those big companies entering the marketplace again because, buying a home is... it's been the American dream, right? And that you've always heard that, but it really is a great investment for long term for a lot of companies and a lot of people. And, we saw a lot of individuals just buying, homes as rentals, with interest rates being down as low as they were. It was super attractive. So it's all going to be a function of what happens in the market with rates and prices and everything else.
And everybody needs a place to live. I mean, we all need a place to live.
It's shelter.
Right. So, I mean, I'd rather own a home than be renting if possible, and there's tax benefits.
With all those benefits, I mean, the number one wealth creator in this country is real estate. And what we saw from 2010 to 2020, about 8 million single family units became rentals. And a lot of that was because, rates were low and people were ready to move. And rather than selling that house, they kept it as a rental. So it's been a happening for over a decade. We just saw the explosion of it when money got so cheap.
Yeah. There's no reason to sell unless you're trying to cash out, right? Looking for that long-term wealth. If you're getting 2%, 3%, why would you sell? Right. And if you could refi your current home and 2% or 3% and then go out and buy maybe your dream home, either your bigger house or your downsize home, and keep the one at a 2 or 3% and get another loan at 2 or 3%, created that scarcity in the market. And that's what drove those prices up.
Absolutely.
Well, what we're starting to see, I'm getting a lot of questions about is, assuming someone's mortgage. That hasn't happened in a long time. And now it's becoming quite often. People are, hey, what's required if, someone wants to assume that mortgage? Anyone with a mortgage in the twos, especially, that rate is valuable. Mm-hmm. That loan that you have on that house is worth money.
Yeah.
And, if you're going to let someone assume that mortgage, you're going to get a higher price for that house, letting them assume the existing terms, having your cost of funds being so dirt cheap. Mm-hmm.
And, that's something that we're starting to see. These people, we had a lot of panic buyers over the last couple of years that maybe put in 2, 3. I had one client that had put in 8 offers and all got outbid. Cash buyers came in, California buyers came in, and just overbid on the home. So imagine you're in that scenario. First of all, emotionally, you're deflated at that point, right? And then your real estate agent calls you up and says, hey, listen, this new home just came on the market, or I just came into my office and it's posted on the board. It's going to hit the MLS. You just got to put in an offer. You got to trust me, right? And maybe they live in a different state. And so you had these panic buyers that were going in and just writing sight unseen offers, waiving all inspections, waiving everything, paying $30,000, $40,000 over the home just to get a home because maybe their loan was going to expire at the end of the month. So their rate rather. So they buy these homes and then they're in them for 6 months, a year, and they realize, I hate my neighbors. It's too far from work. I don't like the school my kids are going to. I don't like the layout of the home. I bought this thing and now I'm stuck. Because now not only are they stuck in the home because they overpaid for it, but now that home is probably worth 10, 15% less than what the rate was when they or what the value was when they bought it. And what can they do? They can't get out of it. They can't sell it.
Well, they're going to do what people should have done during the housing crisis. They should have steered the course. They should have rented out that home. Mm-hmm. Anyone during the housing crisis that walked away from a home, that house is worth more today than it was back then.
3 times more.
Right.
It's worth more. It may not be a lot more in some instances. We had really elevated prices. It was crazy. But, the house value may have dropped by 60, 70%, but you fast forward a decade later, or 15 years later, it's worth more now.
Yeah.
So, having that cheap cost of funds, and if you're into a home that you may be overpaid in, what are you going to do? Just rent it out. Buy the house you really, really want. Mm-hmm. You should never sell a house if you have a rate in the 2s or the low 3s. It's you have a very valuable asset.
Yeah.
And rent that house out and have a tenant pay off your mortgage, and buy something else. Mm-hmm. And for qualifying for a new loan, it's easy. You can use 75% of whatever that rent is going to be on a lease as income for qualifying. And oftentimes that offsets the entire mortgage payment that they have in the house, especially if they have such a low rate on it.
I totally agree. I've had a house personally that I live in now that I had rented for 10 years, and they helped pay down a lot of my home. And then I was able to buy it, for very inexpensive because most of the mortgage was paid down.
Yeah. So what do you have to have a renter in place in order to use that 75% credit?
You just have to have a lease agreement. So if you have a new lease agreement, you can use 75% of a vacating property that you're leaving and use 75% of that lease amount that you're going to rent it out for as income. So if you're renting it for, let's say, $2,000 a month, you have $1,500 in income. And if your payment's $1,600, you only have a $100 a month deficit. Mm-hmm. Or if it's $1,500, now your payment just washes out. You just obviously aren't going to be able to take advantage of using any of that equity from it if it's not being sold to put down on the next home. But what I've advised a lot of people to do while you're living in that home is go get some sort of HELOC if you have a ton of equity, and you can use those funds on that property. Yeah. To put down on something else.
I have a question. Want. When you have a HELOC loan, does it fluctuate or it depends on the loan or?
So any sort of second mortgage, most popular is HELOC, home equity line of credit. Most HELOCs, the rate is adjustable, and it's going to be tied to prime rate, whatever prime is. And each time you see the Fed increasing rates, prime's going up by that same amount. So if you see the Fed's increased rates 75 basis points, you know that the prime rate went up 0.75%. Mm-hmm. And so, to calculate your actual payment or your interest rate on your HELOC, it consists of 2 things. You have a bank's profit margin, and that is added to whatever prime rate is. So prime rate was, around 2% for a long time. I think it's 4 something now, almost 5%. So you would add that if your bank's profit margin is 2%, you would add that to prime rate. That's going to determine your HELOC rate. So, Federal Reserve has increased rates 4 times this year. They've done 2 50 basis point increases and 2 75 basis point increases. So
and they're talking about one more of each of those.
So that's 2.5%. So most HELOCs have gone up 2.5% since the Fed started increasing rates. And if they do another couple of increases, you're looking probably about another % that it's going to be up. So that's the one downside to a HELOC is the rate's adjustable. It's going to be tied to prime. and if rates are going up, your rate is going up on that second mortgage. Thank goodness that it's probably a small amount of money compared to your first mortgage. And thank goodness that if you have one, you probably have a first mortgage tied to it that, is in first position, that has got some sort of rate that is substantially lower. And it's still a very inexpensive cost of funds.
Right.
With the Fed increasing rates, it impacts credit card rates, it increases auto loan rates, it increases,
Everything.
prime rate, which
Everything.
ties to mortgages in regards to HELOCs. But you can use those funds, and having a HELOC and having access to some of your equity is very powerful. So you can make the right move, financially, and have access to funds, and it's still an attractive rate compared to other sources of funds.
For sure.
Good to know. Well, it's good to be mindful. Last but not least, I want to go back to Adam, and if we could talk about, like, even we had a launch and how successful that was, and the benefits of the program that we work with.
Yeah. Well, great job on putting that together, by the way. I think you got 2 offers out of it.
2 offers.
Yeah. The biggest benefit to the program is just the convenience to the sellers. The 72 programs. Just, it's so much more convenient than having to go back to the old school way of doing things. Everything's kind of done behind the scenes. It's, the marketing side of it is just, it exposes you to, the entire market, and then uses not only the power of marketing and the power of, updated photography. I mean, I say it all the time. I go, the type of photography that we can take on our cell phones that we have in our pockets today blows away photos from $5,000 Nikon cameras from 10 years ago. I mean, it's just, somebody doesn't have to do daily showings, daily walkthroughs. You could be, looking to maybe buy a home out here in Arizona from Ohio or Iowa, or, secondary home. What are you going to do? Fly out here in the middle of summer and drive around with a realtor at 115 degrees? Forget about it. Everything can be done online, virtually, on a digital platform. And then bringing those buyers together and essentially looking to see what top of market value would be for that home, and then simply giving that information to our clients and letting them decide if it's good enough for them or not. And we can do that in such a short period of time that it eliminates all those, the weeks and the drag out that you'd normally be exposed to, especially in a market where buyers are really in control at this point, and you have a lot of window shoppers out there that, just waste a lot of time because, maybe they're fantasizing about a neighborhood or a home, and, they got to call you up and come walk through your home. You got a bunch of strangers trampling through. None of that happens in our program.
We eliminate it. We
eliminate all of that. We get rid of the tire kickers. We're in contact with the buyers and the buyer's agents. And then we figure out who really is, a qualified buyer. And then we bring those buyers together and essentially let the market determine, what the value of your home is. Ultimately, remember this: something in this world is worth what somebody's willing to pay. It could be a home. It could be a piece of furniture. It could be a piece of artwork. It could be, the Tesla out there. So it's not an agent's job to tell you. It's not Zillow's job to tell you. It's not even a real estate appraiser's job to tell you what your home is worth. The market will tell you what your home is worth. Let's expose it to the market, put those buyers together, and let them determine what it's worth to them. Because the investor that's looking to buy a home, that they're just going to plug it into a spreadsheet. They're going to see what they have to pay for the home, what taxes are, insurance, what they can rent it for, what's the HOA, vacancy rate, how much do they have to put in the home to get it ready. And that spreadsheet's going to spit out a number. That's what the home is worth to them. But somebody that might move out here from Colorado and they just retired, and their daughter goes to school down here and is engaged and is going to get married, and they have a grandkid on the way, and they happen to live 2 streets away. Well, the value of your home is completely different value to them than it would be for that investor. Yep. So that's what we want to do. We want to make sure we see everybody's point of view and then provide that information free of charge, not a penny to our clients. We'll give you that information for free and determine what you want to do at that point.
And then they're not obligated to take the offer. They can say, okay, this is what your house is worth. And
take it from there.
And what's great about it is we really ask the sellers like what they want. What would be exciting for you if we brought you that much money? And because we know that knowledge and the systems that we're working with, 9 times out of 10 we do. Even this morning, Adam, when I was telling him what the seller wanted, he's like, okay, good luck with that. And this morning, what happened? There's that offer.
Yeah. So, well, we can dive into some details on that on our next episode.
Great.
Yeah.
Well, I just want to thank everyone for being here, and thank you all my new friends, and Adam, Ryan, and Sarah for being here, and want to invite you to join us again next week.
All right. Thanks for having us here.